Steve Hanke, professor of applied economics at Johns Hopkins University and the founder and co-director of the Institute for Applied Economics, Global Health, and the Study of Business Enterprise. It is so great to welcome you on the show. Dr. Hanke, thank you so much for joining me this morning.
It's great to be with you, Julia.
Well, I have to say, Steve, you are one of the most requested guests that I have received on this show. So it's an honor to have you on. And I was hoping we could start where I usually like to start with my guest, and that is with the big picture, the macro view. What is that for you today? What is your assessment of the global economy and also here domestically in the US?
Okay, the to get the big picture, you have to have some kind of model for what we call national income determination. That is where the gross national product, the GDP, is going. And the most reliable model for that's something called the quantity theory of money. It's something that what people who are called monetarists embrace. And the nub of that is that it's the money supply that drives the economy one way or another. So if you get a big excess growth in the money supply, as we had in early 2020, on into 2021, actually, when COVID started, the money supply was growing at over 20% year over year. It was unprecedented. We never had that high a rate of growth in the money supply in the United States. Well, not surprisingly, with a lag of about 12 to 24 months, you get inflation after you have excess growth in the money supply. And we got plenty of inflation. And using, by the way, the quantity theory of money, John Greenwood and I anticipated exactly what was going to happen. We said the inflation rate would go up to between 6 and maybe as high as 9%. And it did peak out at 9.1%. Now, of course, the picture is different. The Federal Reserve is throwing the money machine into reverse, and the money supply is actually contracting now. If you look at the money supply now versus a year ago, it's actually 4.6% smaller than it was a year ago. So it's shrinking. And we haven't had that kind of shrinkage. This is very unusual. We haven't had that kind of shrinkage since 1938-39 period. So what's happening now? Inflation is coming down. We just had inflation numbers yesterday. The consumer price index went down to 4%. And using the quantity theory of money, Greenwood and I have predicted by the year end, and we did this in February actually, we predicted that by year end, the inflation rate would be between 2 and 5%. Well, it's already down at 4%. I think it's going to be closer to the low end of that range than the high end of the range. But the point is, using this model for national income determination, the quantity theory of money, it's all about money. You can track the course of the economy and the course of inflation also. That's part of the economy. I mean, the nominal GDP includes two components: the real GDP and the inflation component. So we're going to see, I think, a continued decline in inflation in the United States, and we will see probably a pretty good recession because of this negative growth rate. So we're going to have some interesting times in the next 12 months. A recession and a sharp reduction in inflation. The inflation story is basically over because the Fed not only slammed on their brakes, it threw everything in reverse, and when we've had this unprecedented shrinkage in the money supply. So that's the rough, broad picture in the United States. Now, if you go around the world, the picture is somewhat similar in the United Kingdom and in Europe. It's a little bit different in India which is a big economy, and China, of course, which is a very big economy. Those places are growing with a little bit more health than they are in the United States, although they're not without their problems. But when you look at the global picture, by the way, it's very important to think about inflation, because inflation is a local problem. It's created by local central banks, Julia. It's not a global thing. You read the newspaper and they're talking about, oh, the global inflation, the global this, the global that. No, it's local. And if you look at right now, in the United States, the inflation rate's 4%. In Canada, it's 4.4. That is about the same. But then if you go to China, it's only 0.2%. There's essentially no inflation in China because they follow the quantity theory of money. They haven't been producing excess money. Then the Eurozone, that jumps up a little. It's higher than ours at 6.1%. Japan, 3.5%. Switzerland, 2.2%. United Kingdom's pretty high, 8.7%. And then India, it's down at 4.3. So these inflation numbers are all over the place, and they're not global. They're created by these local central banks, how much money they're producing.
Yes, indeed. And that is so helpful to frame up the conversation. A couple of areas I'd love to explore a little bit further with you. And you're right. I went back and looked at the piece that you co-authored in the summer of 2021 with John Greenwood, and you both hit the bullseye on the inflation using the quantity theory of money. So my question for you is, what is your thought on how the Federal Reserve has handled inflation? Do you think that, I mean, I'm just curious what you think. Do you think they're going to take a victory lap on this one, or are we going to see some unintended consequences?
Well, the Fed has been a complete disaster because they have blatantly and openly rejected the quantity theory of money. They don't look at the quantity of money, and they don't include it in their policy deliberations. And as a result, that's why we had so much inflation. They weren't looking at the money supply. They goosed the money supply. As I said, it was up over 20% year over year rate of growth, unprecedented. And we then, with a lag of 12 to 24 months, we started getting an inflation coming into the picture. Now they're doing just the reverse. They're not looking at the money supply. They've thrown the thing into reverse. The money supply on a year over year basis is shrinking at negative 4.6%. So they're just all over the place. And I think the problem is that they will continue, I think, to eventually increase the federal funds rate a little bit, not as rapidly as they have been doing. They have a meeting tomorrow, and chances are they'll probably not do anything. They'll probably not make a change. That's what's in the markets anyway. If you look at the federal funds futures market, there's only a small probability that they'll increase the federal funds rate. This meeting coming up tomorrow, the next meeting, it looks like the probability that they'll increase by 25 basis points is something around between 60 and 70% chance. So they're going to keep with this tightening kind of thing, and the quantitative tightening, increasing the Fed, leaving the Fed funds rate up where it is, or maybe a little bit higher, and continue with shrinkage of the balance sheet of the Federal Reserve and their quantitative tightening. And in addition, the banks, especially since the Silicon Valley banking problems erupted a few months ago, we have the banks operating on a lot tighter leash than they have been in the past. And so their contribution to the increase or change in the money supply has become very small. They've tightened things up. So if you want to get credit now, it's, you know, the Fed has to be very careful. They've got 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 to be very careful. They' It's harder to get than it used to be. So, so if you put all that together, it looks like they're just headed down the wrong road, and they're going to give us a recession, and maybe a pretty good recession. The longer they keep squeezing the money supply, the deeper the recession will be, and the longer it will last. So they've got everything wrong, basically. They never predicted we were going to have. Remember inflation? They said that was a transitory thing, a temporary thing.
Yeah.
Well, now what are they saying? Now they're saying it's a permanent thing. And if you read the papers they repeat what the Fed says, of course, all the journalists. Oh, we have a problem. We have this persistent inflation. And they're still going on about the headache the Fed has because they're going to have to fight this persistent inflation. And that's just after the inflation tumbled down to from 4.9% to 4% last month. So that's the picture. The picture is really an incompetent Fed. I mean, I think the Fed is completely incompetent. You have 785 economists in the Federal Reserve System, and not one of them could predict that we were going to have an inflation problem because they weren't looking at the money supply. Now, by the way, I've done a big study that I've just completed of 147 countries since 1990 until 2021. And I've looked at the annual change in the money supply versus the annual change in inflation in those 147 countries. And what did I find, Julia? I found that the relationship was almost 1-to-1.
Yeah.
You change a money supply by one, and you get a one change in a 1% change in the inflation rate. So this is consistent with something that Milton Friedman observed a long time ago, and that is that there is this 1-to-1 linkage between changes in the money supply and changes in inflation, and that's exactly what I was able to show with data from 147 countries. The correlation coefficient actually was 0.94.
Wow. That's incredible. Let me ask you this, because you mentioned that study, 147 countries. You've looked at this so deeply. Even the articles, the op-eds that you and John Greenwood put out back in 2021, when you both nailed inflation, and also more recently, you were not surprised by the CPI report that we got for the month of May. And it seems like this formula, it works. You can see the correlation. Why do you think the Fed, they have all these economists, why did they ignore it? And I guess maybe my other question is, how did you get into being more of a monetarist, if you will, following this theory?
Well, the answer to the getting more into the monetarist, there were kind of several linkages. One of my mentors turned out to be Milton Friedman, who's kind of the dean of monetarists, shall we say, in the 20th century for sure. And also, I was influenced by another monetarist, perhaps one of the most famous ones in Britain, Sir Alan Walters. And Sir Alan was Margaret Thatcher's economic guru, and he also was a colleague of mine because he was a professor at Johns Hopkins. We edited a couple books together. We used to write a Forbes column together, wrote scholarly articles together, and that sort of thing. So he influenced me, and he had been very influenced, by the way, by Milton Friedman. So that's the line of influence, if you will.
And then on the, well, maybe a quick question follow on. So you knew Milton Friedman. What can you tell us, like, what that was like, or what was like knowing him? Just curious.
Well, he was a great economist and a very generous man, an excellent mentor, and had a great sense of humor too. He was just a wonderful guy to have as a associate, shall we say?
Yeah.
Very, very helpful.
Yeah. I love that. And then on the point about why do you think the Fed doesn't pay attention to the quantity theory of money? Why is that? Is that surprising that they
Well,
don't?
I think there's one um, there's one theoretical reason really, and that is that the models that they use are what are called post-Keynesian models, and they don't include money. So the central bank's using a macroeconomic model to try to determine what the course of the economy is going to be and what the inflation rate's going to be, and all those economic variables that are associated with macroeconomics. But the model does not include money. Now, the monetarist model, of course, does include money. I mean, the equation of exchange, a basic identity in monetarism is MV, M is a money supply, V is its velocity, equals P, the price level, times Y, real, which is real economic activity. So MV equals PY, that's a monetarist model, and M is in there. And by the way, if you rearrange that identity and solve for M and what I call the golden growth rate being the growth rate in the money supply that's consistent with the Fed hitting its inflation target at 2%. If you solve that thing, you end up with the growth rate in the money supply broadly measured by what we call M2, that measurement. It should be around 6%. Now, remember, what did I say they were doing 2020, 2021? We got up over 20%. Mm-hmm. So they were growing the money supply over three times faster than would have been consistent with hitting a 2% inflation target. And now they're negative 4.6% year over year, which is way lower than the golden growth rate of 6% that's consistent with a 2% inflation target. And of course, that's one reason inflation's falling so fast. So what they should be doing is not worrying. Interest rates are a very poor indicator of the tenor of monetary policy. It's all about what is going on with the growth in the money supply. So they should be paying attention to that. And actually, instead of squeezing, they should be allowing that money supply to increase and grow by more or less 6% per year.
Yeah. I want to hear more on that we're currently on a course here, like in the economy based on this. We're on the course headed for a recession. I want to hear more on your thoughts on that. Also, I imagine all of this, it kind of operates at a lag. I just want to hear more about how that kind of works and how you're thinking about the severity of the recession. And then we can start to maybe get into like preparing for that as well.
Well, you bring up lags, Julia, which is a very important thing, because here's the transmission mechanism that you have when using the quantity theory of money. You get substantial changes in the quantity of money, and then with a lag of about 1 to 9 months, asset prices and sensitive commodity prices start changing. And then with another lag after that change in the money supply of about 6 to 18 months, economic activity, real GDP starts changing. The rate of growth in real GDP starts changing. And then, as I mentioned earlier, with a real long lag that's variable of about 12 to 24 months, you have a change in the price level or inflation. So the reason people get so confused when they're thinking about these things, they're looking at the data today. Everybody's very data dependent. And this is a big problem with the Fed. They're data dependent. They're looking at the data today, to what's going on today. So if you were looking at the money supply today, well, you would have to factor in all these lags to actually be able to predict what was going to happen to asset prices, what was going to happen to sensitive commodity prices, what was going to be happening economic activity and inflation. So it's the lags that throw people off, and that's where the sharp pencil comes in. You've really got to know what you're doing. You just can't have a simplistic perspective once you start looking at the changes in the money supply. You've got to get these lags worked in there, which can be tricky to do. It takes a little experience.
Exactly. And something you have many years of experience in this arena. And I'm curious too, like, how do you prepare for the impending recession? If you are able to share how you prepare for that.
Well, uh, for one thing, if you really are anticipating a recession, you've got to adjust your portfolio, your balance sheet, so to speak, to uh, in expectation of a soft patch in the economy. So that's the main thing. If you think things are going to slow down, you have to anticipate it correctly and adjust. So you certainly don't want to be holding a lot of speculative stocks and junk bonds and that sort of thing. So you want to get cash heavy and shall we say conservative, and you want to get cash heavy because eventually after the recession, what's going to happen? Prices will get soft during the recession, and there'll be opportunities to redeploy your cash into things that are attractive price wise, because once the recession is over and the recovery starts, prices will start firming up.
Yeah. I want to hear, how about gold? What are your thoughts on gold?
Well, my my long term thoughts, kind of fundamentally, is I'm bullish on gold, but the the way there are two ways to deal with gold, and one thing, by the way, you asked earlier, how would you prepare for a recession? Well, one thing, you want to be long. You want some gold in your portfolio because gold does well in a recession, and gold has been, you know, it hasn't been skyrocketing to the moon, but it's been pretty stable, and if not on the strong side. So you want some gold in your portfolio. The one thing that I've been doing with Abe Kaufness, however, is looking at gold and measuring the sentiment in the gold market, whether the sentiment is bullish or bearish. And we do that by what we call text mining. We look at every article that comes out on an hourly basis, and the computer does this. We're not reading all and the text mining is we're looking for words, bullish and bearish words contained in these articles that are addressing gold and the gold market. And by doing that, it's like putting a thermometer in somebody's mouth. You can see if the temperature is going up or temperature is going down with high frequency data every hour. So by doing that, we come up with what we call the Hanke Kaufness Gold Sentiment Index or score. And that then we hook up to trading algorithms that tell you when to buy or sell. And those over the past year or so have been doing very well. Depending on the algorithm, the returns have been between about 30 and 50%. So with this high frequency data, you don't have to really have a position about whether you think the gold market's going up over the long run or going down in the long run or staying flat. No matter where it's going, the prices will be fluctuating around the trend. Even if the price is flat and it doesn't do anything, there'll be fluctuations. The sentiment will change. The bullish and bearish sentiment will change. And by using this index, and hooked up to these algorithms for trading, we're able to trade on a high frequency basis and do so very successfully. And if you want to see what we're doing and get more detail on that, you just go to www.thegoalsentimentreport www.thegoalsentimentreport.com, and you can find out how that works.
That's awesome.
So,
Well, I'll check that out.
so that's it on gold. You want some before a recession for sure, and if you're more inclined towards trading on a rather high frequency basis, you can go to the Hanke Gold Sentiment Score and see when the score gets very bullish. The sentiment, for example, we're reading these articles every hour, and all of a sudden things get very, very bullish. What happens is that is a signal to do what? It isn't to buy, it's to liquidate your long position or go short, because that sentiment will swing back the other way. The sentiment's moving, bullish, bearish, all the time. And so if it goes over on the bearish side and at an extreme, you want to be buying. So the signal will be the bearish, but the algorithm will be switching to buy. When everybody is bearish, you know that's an extreme, and it will revert back to, let's say, a neutral position, or maybe even a bullish position. So that's how you use the sentiment index in trading.
Very cool. I love that. Well, we'll definitely check that out. We only have a few more minutes, and I want to bring up your newest book that you co-authored on lockdowns, entitled "Did Lockdowns Work? The Verdict on COVID Restrictions." And I know you all did a deep dive into this, and it was one of the biggest policy mistakes. Would love to hear what you and your co-authors found in your research. Would love to pass it to you to frame it up for us.
Okay. By the way, Julia, the Institute for Economic Affairs in London published the book, and it is available at no charge online. 220-page book. It's, as they say, it's a good buy. The price is zero. So, at any rate, what we did what's called a meta-analysis, and a meta-analysis is an analysis that really, in prior days, we'd call this a review of the literature, review of what the findings have been by the researchers that have been dealing with the topic. And what we looked at are, we started with 19,646 possible studies, and we narrowed it down to only 22 that were high quality and could be normalized their findings so that we could actually compare them. And the results were that we were looking at the effects of lockdowns and the stringency of lockdowns relative to mortality. In other words, did the lockdowns save lives or not? And what we found is that for Europe, the lockdowns saved approximately 6,000 lives, and in the United States, about 4,000 lives. Now, to put that into context, those are, a death is a death, which is bad, but in relative terms, these are pretty tiny savings. They only reduced mortality by about 3.2%. Those numbers that I gave you, again, 6,000 avoided deaths in Europe. The usual normal flu season in Europe, about 72,000 people die. In the United States, about 38,000 people die in a flu season from flu, and the lockdowns in the United States uh, saved about 4,000 lives. So the effect of lockdowns was tiny from a health point of view, from a mortality point of view, but from an economic point of view, of course, the whole economy was shut down. It was a complete disaster. So you had big economic losses due to the lockdown, and you had a lot of social losses. Education uh, was slammed pretty hard, and so the costs were enormous, and the benefits were tiny. So that's the conclusion was that the lockdowns were probably the biggest public policy blunder that we've had in modern times. And the problem is, it looks like no one's paying much attention to what actually happened, and we might be in for the same kind of trouble again if in fact something like COVID rears its ugly head.
Because I imagine we are still feeling the effects of the lockdowns. 'Cause there's like the social and economic costs that come with it. And what I'm hearing from you is you think that policymakers would choose lockdowns again, in light of what we've learned?
Well, what happens? The pattern is that the epidemiologists have models, and the models predicted, for example, the big model from Imperial College in London was predicting that over 2 million lives would be lost in the United States if we didn't lock down. So you can see these epidemiological models put the fear of God into you because they have very high numbers that they spin out, and once those numbers are out there, fear is out there, and the politicians panic and do what they did in the United States or the United Kingdom or most of Europe. Sweden was spared a lot of this. They had very, shall we say, a light touch approach to COVID, and as a result of that, the damage wasn't nearly as great in Sweden, and the health effects were more or less the same as they were in places where you had the lockdowns, because the lockdowns didn't really do much from a health point of view.
Yeah. Well, Dr. Hanke, I have to say, I've really enjoyed having you on, and I am so sorry that our time is short this time around, but I would love to have you back on in the future because I learned a lot from you just in this 45 minutes. If you want to let folks know, or maybe they can follow you on social media, read some of your work, whether it's your research, your books, please take a moment to share.
Yes, I think one way is on Twitter. I have a fairly large following, uh, over 600,000 on Twitter, and that's just at Steve underscore Hanke, Hanke, at Steve underscore Hanke. So that's one uh, mechanism. The other is to go to the Independent Institute website, and they post and archive all of my articles. And if somebody wants to be included on my distribution list, they can just email me and indicate that they've been on the Julia La Roche show, and they've seen our interview, and they send an email to me at Hanke, Hanke, at jhu.edu.
I
I'll put them on my distribution.
I love that. Well, Steve Hanke, professor of applied economics at Johns Hopkins University, thank you so much for being so generous with your time and your ideas. I really appreciate you coming on. Thanks again, Steve.